You know how a patient can look stable while their vitals are quietly dropping? Your money is exactly like that. It can grow on its own unless you're keeping it somewhere it can't breathe. Nurses, dentists, doctors, allied health professionals. This is the Investing 101 you should have gotten with your first payslip. I'm Penny Kwan, your coffee-loving money bestie who helps healthcare professionals like yourself grow wealth, even when you're burnout. Most healthcare professionals aren't bad with money. You're exhausted. Everyone says, save your money. But nobody explains that saving alone doesn't grow anything. Investing is simply this: your money working a shift when you aren't. While you're sleeping, while you're charting, while you're running across wards. And every year you don't invest, you lose a year of compounding you can't get back. Okay, so stocks. When you buy a stock, you're buying a tiny piece of a real company, like owning 0.0001% of a business. Big companies list their shares on exchanges like SGX, Nasdaq, NYSE, so anyone can buy or sell. When a company earns profits, it can 1. Reinvest everything into growth, 2. Pay you dividends, either through real cash or extra shares, and that's the upside. Stocks can grow for decades, but the honest risk, if a company collapses, shareholders are last in line. Your shares can go to zero. Not common for huge, stable companies, but it's still part of the deal. Let's talk about bonds. Bonds are totally different. A bond is not ownership, it's a loan. You're lending money to a company or the government. Every bond has a maturity date, 5, 10, 30 years, a coupon, the yearly interest they pay you, and at maturity you get your full amount back. Because bondholders get paid before shareholders if a company fails, bonds are considered safer, but usually they grow slower. For example, let's say you lend Tesla $1,000 for 30 years by buying their bonds. During these 30 years, Tesla pays you an interest every single year. Now, the interest is known as the coupon. At the 30-year mark, the maturity date, Tesla must return you your full $1,000 that you originally lent them. This is why bonds feel steadier. You know the interest you get, and you know when your money comes back. Now, let's move on to mutual funds. A mutual fund or unit trust is a collection of hundreds of stocks or bonds run by professionals. You buy one fund and instantly own small slices of everything inside. So instead of betting on one company, you're spreading the risk. The downside? Higher fees, and trades only happen once a day. Next, ETFs. ETFs are my favorite for busy healthcare professionals. Think a mutual fund, but simpler, cheaper, and easier to buy. Most ETFs track an index, like the SCI or S&P 500. So one ETF invests you into entire groups of companies at once. If one company fails, your portfolio barely feels it. This is how normal people, not finance bros, quietly build wealth. Here's your protocol, quick and clean. Step 1, know the tools. Stocks equals ownership. Bonds equals lending. Mutual funds equals curated group. ETFs equals simple, low-cost group. Step 2, start with diversification. One ETF equals hundreds of companies. Zero stock picking needed. Step 3, invest regularly, every month, automatically. Time in the market is better than timing the market. People think investing is for the rich, the confident, the finance bros. But the truth, investing is how normal working people stop trading their entire lives for their paycheck. And honestly, I avoided investing for years because it felt too intimidating. But once I understood the basics, it felt like someone finally took my money out of ICU. You spend your whole life caring for others. Your money deserves the same care, and it doesn't need to be complicated.